option selling. Only two strategies you need to know: sell a put, sell a covered call, and it works for big accounts, small accounts, all accounts in between. Somebody put on my YouTube channel recently, he said he had a smaller account and he wanted some suggestions for stocks to trade under $100. Well, guess what, Antonio? This video is for you. I pulled up a whole bunch of stocks under $100, big name stocks, lots of companies that you've heard of before. And I'm going to walk through a few trades with you right here. Check it out. Let's jump right in. All right. So I made this whole list. Check out my watch list here, and it's sorted by price per share. So I just listed a bunch of big name stocks under $100. If you want this list, comment in the comment section list and I will send it to you. Join my inner circle. That way I can email it to you. I'm going to share all these great ideas and more. Check it out. So first, I'm going to go through a stock for NEO. Now, NEO, I used to trade NEO a long time ago. It's been many, many years. NEO is like the baby Tesla. It's kind of like the Chinese version of Tesla. And it has a lot of volatility. And I like trading stocks that have a lot of volatility. Number one, because typically you make more in premium, the higher the volatility. And number two, when a stock has a lot of swing, it goes up a lot and it goes down a lot, it really gives you a great opportunity to sell puts. And then if you have to buy the shares, you could turn right around and sell calls. And guess what, guys? When you trade a stock that has a lot of ups and downs, that's better when you're trading, because if you buy it and then you sell a call against it, there's a lot of opportunities for that stock to go back up, sell your shares, and take in premium all along the way. Now, I'm going to show you, walking through my platform, how easy this can be. So let's check it out. NEO right now is about $7.50 per share. So very, very inexpensive. Let's say I wanted to buy 100 shares of NEO at the price it's trading at now, 7.495. And then right away, I want to sell a $7.50 call. That's going for $22 for the contract. So you're paid $22 and you get to keep that no matter what happens. What you're doing is you're committing to sell your shares if the price stays above 750 when the contract expires on October 10th. That's about 4 days away. So we're going to calculate our rate of return. So we're making $22 in premium and we're putting up $749 because it's 7.499 per share. And that gives us a rate of return of almost 3%, but we're only holding it for 4 days. So what we want to do is we want to annualize that number, because we want to compare apples to apples. Anytime we're looking at rates of return, we want to get an annualized rate of return to compare apples to apples. So I'm going to divide that by 4 because we're holding it for 4 days. And I'm going to multiply it by 252 because there's 252 trading days per year. And that gives us an annualized rate of return of 185%, guys. Pretty dope, right? Okay, let's check another stock and let's look at a put for another stock. Let's look at Mara. I haven't looked at Mara in a while, and I used to trade this quite often. It's a Bitcoin kind of company. I love Bitcoin because over time, Bitcoin for sure goes up. We all know that. So I'm comfortable selling a put and having to buy the shares because I'm pretty confident that over time, even if it has some volatility, it will go up. So let's take a look. So Mara right now is trading at $19.95 per share. So we're going to look at a 1950 put. So what I'm doing is I'm committing to buy 100 shares at 1950, but only if it drops below 1950 when it expires on October 10th. If it doesn't drop below that price, I don't buy the shares. Either way, I keep the premium. Now, right now, that premium is going for $51, right? 0.51. We're always going to multiply by 100 because each contract is 100 shares. And let's take a look at the rate of return. Well, guess what, guys? If I'm making $51 and I'm putting up $19.50, right? Because I'm committing to buy 100 shares at $19.50. So that's $1,950. That gives us a rate of return of about 2.5%. Again, I'm only holding it for 4 days. So I'm going to get my daily return and multiply by how many trading days in a year. That gives us an annualized rate of return of 164%. Now, here's the best thing about selling puts. If the stock does go down below 1950 and I have to buy 100 shares, I'm buying a stock that I already like on sale. and I can turn right around and sell a covered call against it right after I have the shares. What is better than that? So that's a $20 stock, right, Mara? Let's take a look at a $30 stock. One of my favorites is Etha. Matter of fact, I have some positions in Etha right now, as indicated on my board here. Etha is like pegged to Ethereum. I like crypto. I like Bitcoin. I like Ethereum. It gives us a lot of opportunity for consistent income every single week. And I know even if I have to hold the onto the shares for a while, I know over time it's probably going to go up. So let's look at an Etha put as an example. Right now, Etha is $33.93 per share. Let's look at a $33 put. What we're doing is we're saying, okay, if it goes below $33, I'm going to buy 100 shares at 33. Worst case scenario, I'm going to buy a stock that I like on sale. Right now, that particular contract has a delta of 32. What does that mean? It's approximately 32% likelihood that it's going to drop below and stay there, forcing me to have to buy those shares on expiration date, right? It's more likely that it's going to stay above that level, right? But I'm okay if I do have to buy the shares. So how much is that contract going for? It's going for 50 bucks, right? So let's calculate the rate of return. Anybody can do this with a calculator. I'm taking in $50. I'm putting up capital of 3,300. Remember, because I'm selling a $33 put, $33 per share times 100 shares is $3,300. That gives us a rate of return of about 1.5% over the next 4 days. So I'm going to get my daily return by dividing by 4, and I'm going to multiply by 252 to get my annualized rate of return. That gives me a 95% annualized rate of return, and I don't have to put that much money up. Remember, I'm showing you if you put up all the money, you can also use margin on a lot of these stocks. Margin means that you use some of your money and the rest of the bank's money. Why use my own money if I don't have to? Then my rate of return becomes even that much better, right? Now, there is more risk in margin because you want to have enough money. You don't want to have a margin call if you don't have enough capital in your account. That could force the broker dealer to break your trade and recognize a loss. So you don't want that to happen. I do have lots of other videos on margin. So check out those videos if you want to use margin. But in the meantime, let's look at some other stocks. Let's look at a $50 stock. Let's look at Bank of America. Let's stop looking at crypto companies and let's just take a look at a bank, right? So we know based on the 2007, 2008 financial crisis that the government will probably not let banks fail, right? They didn't do that then. They're probably not going to do that moving forward, meaning that Bank of America, it's been around a really long time, probably not going to go out of business. In fact, it's virtually guaranteed by the government that it won't go out of business. So let's take a look at a put on Bank of America. So it's $50.23 per share, as you can see right here. And let's take a look at a 49.50 put, right? So there is a 29 delta, meaning 29% likelihood it's going to drop below 49.50, requiring you to have to buy the shares. Let's also look at the implied volatility. Now, the implied volatility on Bank of America is 30. It's kind of low. So the lower the implied volatility, it doesn't have as much swing, right? So it's a little bit more slow and steady, you might say. When it has a higher volatility, it's got a lot of swing. Typically, I like stocks that have high implied volatility. Number one, because I get paid more. And number two, because I know when it's got all those bounces, I can make money on both sides, right? But let's take a look at something more conservative if you want to get your feet wet as an example. So this contract last traded at $26 per share. So let's see. I'm making $26 and I'm putting up 4,950 because I'm selling a 49.50 put. So that's the amount of capital. If I don't want to use any of the bank's money and I want to use all my money, that's the amount of money that we have to have in our account to make that trade. Now that gives us a rate of return of about a 0.5%. We're going to divide by 4 days because we're holding this for 4 days. And by the way, guys, I'm always looking at 1-week contracts because I don't want to tie up my capital for extended periods of time. I don't know what's going to happen with the stock or the stock market, if it's going to go up or if it's going to go down or if it's going to stay sideways. And I want to make money, consistent money every single week, regardless of where the market goes. So personally, I like 1-week contracts. But if you wanted to, as you trade, you're going to find your groove. Maybe you want to do 2-week contracts or 1 month or 2 months, etc. So you have that flexibility. So now remember, I'm going to multiply by 252 to get our annualized rate of return. And that gives us an annualized rate of return of about 33%. And that makes sense. It's much lower than the last stocks that we looked at because the implied volatility is lower. It's a little bit more slow and steady of a stock. It doesn't go up that much in short periods of time, nor down that much in short periods of time. So the annual rate of return is a little bit lower. Let's take a look at another stock. Let's look at Zoom. I use Zoom all the time. I like to trade companies that I'm familiar with, right? Big companies that have been around a long time. Maybe I use their products or services on an ongoing basis. It gives me a little bit more comfort factor. So let's take a look at Zoom. So Zoom is $79.43 per share. Now let's say I wanted to buy 100 shares right now, and I want to pay sticker price $79.46 per share. And right afterward, I want to sell an $80 call. The reason why I want to sell a call over what I paid is because I never want to sell my shares for less than what I paid for them, right? I don't want to take realized losses ever. So I always want to choose a strike price that's more than I paid if I'm selling a covered call. And I personally always choose the strike that's right over what I paid. So if I paid $79.47 per share, I'm going to sell an $80 call. Well, this particular contract last traded at $77, right? So let's take a look at the annualized rate of return. We're making $77 on our contract. We're putting up $79.49 in money, in capital to make that trade because we're buying 100 shares, right? We're holding the contract for 4 days. So we're going to divide by 4, and then we're going to multiply by 252, which that's the number of trading days per year. And that gives us an annualized rate of return of 61%. Now that makes sense too, because let's take a look at the implied volatility for Zoom. It's far less than a crypto type company, 34%. So it doesn't have as much swing as, let's say, Mara or Etha or something like that, right? Or Neo as an example. Now let's take a look at $100 stock because Antonio wanted to see stocks under $100, and I'm showing you how easy it can be. And I'm literally walk through with you step by step using my program on Thinkorswim. So let's take a look at $100 stock. Let's look at Uber. I mean, who doesn't know Uber, right? Like I take Ubers often. I'm more of an Uber person than a Lyft person. So let's take a look at Uber. So Uber right now is $97.63 per share. And let's look at a put that's kind of far away from where it's trading now. So let's look at, for example, a $94 put. So right now it's $97, but we only want to buy it if it goes down less than $94. So we really want to discount if we have to buy the shares. So there's only a 16 delta. It's only 16% approximate likelihood it's going to go that low by Friday, only over the next handful of days, right? This last traded at $31, right? This contract. So let's take a look at our rate of return. We're going to divide $31 divided by, let me just move my calculator over, divided by 9,400 because we're selling a $94 put, meaning that we're committing to buy 100 shares at $94. That gives us a rate of return of this over 4 days times 252. We're doing the same exact steps that we have been doing, people. That gives us a 20% rate of return. So far, far less. Now, do you want to trade Uber, let's say as an example, and get a 20% rate of return? Maybe, maybe not. That's something that only you have to decide. I'm not here recommending any particular stock. I'm just showing you how to analyze it, the steps that you take. Pick the stock, pick the expiration date, pick the strike price, how you calculate the rate of return. Can you guys see yourself doing this? Listen, this is so easy. I know I've been doing it a really long time, but all this takes is a little bit of practice. Watch these videos over and over again and learn them. I've been putting out a video every day. Make sure that you subscribe to my channel because I'm showing you, I'm walking through lots of different tickers for you. I'm giving you tips, talking about puts, talking about covered calls, talking about margin, all things options trading. That way you can empower yourself and create the lifestyle that you want. Option trading is the best gig in the world. Let me tell you something. I mean, I'm just basically sitting at my counter, once you learn the fundamentals, literally there's not a lot of work. Maybe you spend 20 minutes per day taking a look at your positions, maybe putting a trade in here or there, and you're creating yourself income every single week. It can be a great side gig for you, or it can also replace your income depending on how much capital that you're starting with. Anyway, I hope this helps. Let me know in the comments. Ask me for my list of stocks under $100. Subscribe to my inner circle, and I will gladly send that out to you. Anyway, hope this helps. Cheers for now.